You were born in 1988 in Baton Rouge, Louisiana, not the wealthy part. The part where the houses are small and the yards are chain link and the Dollar General on the corner is the closest thing to a grocery store within walking distance. Your mother worked at a laundromat. Your father worked construction until his back gave out when you were 11, and after that he worked less and drank more. And by the time you were 14, he was mostly a presence that occupied the couch and the refrigerator and not much else. You were not a bad student. You were a distracted one. Distracted by the specific anxiety of a child who can hear her parents fighting about money through the wall at night, who knows which bills are overdue by the color of the envelope, who understands by the age of 9 that the distance between your family and catastrophe is measured in hundreds of dollars and not thousands. You graduated high school in 2006. You did not go to college. College required money you didn't have and time you couldn't afford. Your mother's hours at the laundromat had been cut. Your father's disability application had been denied twice, and someone needed to contribute something real to the household immediately. You got a job at a diner 3 blocks from the high school, then a second job at a big box retail store on weekends, and you sent money home and saved a little and told yourself this was temporary, the way everyone in your situation tells themselves this is temporary. At 22, you moved into your own apartment. Small, second floor, the kind of place where the carpets are a color that has a name, but the name doesn't match what you see, where the windows face a parking lot, where the upstairs neighbor's television is a permanent feature of your life, whether you want it or not. You had a boyfriend for a while. He worked at the same retail store. He was kind. Things were fine until they weren't, and by the time you were 24, you were alone in the apartment, and the rent was the same amount it had been when there were 2 incomes paying it. You made it work. Not comfortably, carefully, the way people with no margin make things work, which involves a particular kind of attention to small numbers that people with margin never develop and never need to. You knew the price of everything you bought. You knew which checkout line was faster, and which gas station was 2 cents cheaper per gallon. You knew that the electric bill would be higher in August, and you started saving for August in June. You were not irresponsible. You were not reckless. You were a person with income of roughly $1,800 a month after taxes and expenses of roughly $1,650, which left you $150 in reserve for everything unexpected in a life that was full of the unexpected. The car broke down in February 2014. Not catastrophically. A relatively minor repair. The mechanic quoted $340. You had $150 in savings, $60 in checking until the next payday in 11 days, and a job that required a car to get to. Without the car, you couldn't get to work. Without work, you couldn't pay rent. The math was simple, and the options were limited. You called your mother. She had nothing. You called your sister. She had less. You called the bank where you had your checking account and asked about a small personal loan. The loan officer was polite, and the answer was no. Your credit score was too low. Your debt-to-income ratio was too high. You didn't have sufficient history of the kind of credit that would qualify you for the kind of credit you were asking for. The circularity of this was not lost on you. Your co-worker at the diner, a woman named Cheryl who was 53 and had been waitressing since before you were born, told you about the place on Airline Highway. They don't check your credit, she said. Just bring your pay stub and your ID. You'll have the money in 20 minutes. She said it the way people say things that are true and also not the whole truth, with the weariness of someone who has used the service herself and is passing on practical information without endorsing the system that made the information necessary. The store was yellow and orange. Cash today in letters visible from a block away. A fast cash sign in the window. A smiling woman in a polo shirt at the counter who processed your application in the time it took to drink a cup of coffee and who handed you $300 in cash. Slightly more than you needed, which felt like generosity and was actually strategy, while explaining the terms in professionally pleasant voice of someone who has explained these terms thousands of times. The fee was $45 per $100 borrowed. You were borrowing $300. The fee was $135. In 14 days on your next payday, you would bring in $435, the principal plus the fee, and the transaction would be complete. You understood this. The annualized rate, if someone had handed you a calculator and asked you to work it out, was approximately 391%. Nobody handed you a calculator. The car needed a belt. You signed the form. You took the cash. You walked out into February Louisiana sun with your problem solved. The car was fixed by that afternoon. You drove to work the next morning. For 11 days, everything was fine. The specific fine of a person who has handled a crisis and is not yet thinking about the next one. Payday came. Your check was $847 after taxes. Rent was due in 4 days, $625. Utilities, $140. Food for 2 weeks. You estimated $120. The loan repayment, $435. Total, $1,320. Available, $847. The gap, $473. You went back to the store on Airline Highway. The woman in the polo shirt explained the rollover. Instead of paying back $435 today, you could pay just a fee, $135, and the $300 principal would roll over for another 2 weeks, generating another $135 fee. This would cost you $135 today instead of $435, which meant you could pay rent and eat and keep the lights on. The total cost of the $300 loan was now $270 in fees, and you still owed the $300. You paid the $135. You drove home. You paid rent. You bought groceries. You told yourself you would pay the whole thing off on the next payday. The next payday, the math was the same. Rent wasn't due, but the electric bill was, and your hours had been cut at the diner because February was slow and the rollover fee was due and the numbers didn't close. You rolled over again, $135 more. The $300 principal was now 3 months old, and you had paid $405 in fees and still owed $300. By month where you opened a second loan at a different store, a green and white place on Florida Boulevard, different company, same product. To cover a gap created partly by the first loan's ongoing fees. Now you had 2 loans, 2 sets of fees, 2 rollover schedules running on slightly different 2-week cycles, 2 stores expecting payment on slightly different days. The organizational complexity of being poor increased. You kept a handwritten calendar on the refrigerator showing payment due dates. You arranged your direct deposit to hit 2 days before the earliest due date. You were managing it. You told yourself you were managing it the way you had always managed everything. Carefully, with full attention to the small numbers. By month 7, you had 4 loans. Not because you were careless, because the fees from 3 loans had created gaps that required a 4th loan to fill, which created a slightly larger gap that required more careful management, which meant any disruption to the schedule, a slow week at the diner, an unexpected expense, an hour cut, cascaded through all 4 accounts simultaneously. The total amount you had originally borrowed across all 4 loans was approximately $1,100. The fees you had paid in 7 months exceeded $900. The principal balances had not decreased. You were paying consistently and on time, and the debt was not shrinking because the fees consumed everything you paid before it could touch the principal. This is the mechanism, not a side effect. The design. Payday lenders generate the majority of their revenue not from borrowers who take one loan and repay it, but from borrowers who roll over repeatedly. The CFPB found that 4 out of 5 payday loans are rolled over or renewed, and that borrowers who roll over are indebted for an average of 200 days in a given year. The business model requires the trap to function. The yellow and orange store on Airline Highway was not a financial service. It was a subscription service with a $135 monthly fee attached to a $300 debt that would never disappear as long as you kept paying only the fees. You knew this on some level by month 8. You knew it the way you knew the price of gas and the color of overdue envelopes. Not as an abstraction, but as a lived arithmetic. You also knew that the alternative to paying the fees was defaulting, and default meant the lender could sue you, could pursue your wages through garnishment, could report you collections, could make the situation considerably more complicated. The fees were the cost of staying in the system. You stayed in the system because leaving the system required a lump sum you didn't have and couldn't accumulate because the fees were consuming the margin that would have allowed you to accumulate it. You got a third job in month 9. Weekends at a hotel, cleaning rooms. You worked 6 days a week, 50 to 60 hours, across 3 employers. You used the extra income to pay down one principal. You chose the smallest loan, $200, and paid it off completely in 3 weeks. The victory was real, and it was also immediately complicated. The $200 per month you had been paying fees on that loan now needed to go somewhere, and it went to the growing gap created by the other 3 loans and the cost of working 60 hours a week, which included more fast food because you had no time to cook, more gas because you were driving between 3 jobs, more coffee because you needed to be awake, more over-the-counter medication because your body was beginning to register the schedule at a cellular level. You developed a pain in your lower back sometime in month 11. Not dramatic. The kind of persistent ache that starts as an annoyance and graduates to a background condition that you learn to manage the way you manage everything else. You didn't go to the doctor. You didn't have insurance. The diner didn't offer it. The retail job required 30 hours minimum for benefits, and they kept you at 28. The hotel was weekend casual. You bought ibuprofen in the large economy bottle. You worked through it. You'd always worked through things. Working through things was a skill that had gotten you this far, and it was also the skill that was eating you. Month 14. 5 loans. Total principal outstanding. Approximately $1,400. Total fees paid over 14 months. Over $2,000. Net debt movement. 0. You had paid more than you borrowed, and owed the same amount you had started with. You started using the loans for things you wouldn't have used them for in the beginning, not luxuries, necessities that had slipped out of reach as the fees consumed the margin. Your daughter's school shoes, a prescription that the over-the-counter alternative wasn't handling, a phone bill that needed to be paid to keep the number that your employers called you on. Each new use of a loan felt different from the previous ones, less like an emergency measure and more like income, a supplementary cash flow that you had incorporated into your budget the way you had incorporated the electric bill. You understood this was wrong. Understanding it was wrong didn't make the shoes less necessary. The eviction notice arrived in month 18. Not because you hadn't been paying rent. You had been paying rent, always first, non-negotiable. It arrived because your landlord was selling the building, and all tenants were given 60 days. You needed first and last month's rent plus a security deposit for any new apartment, approximately $1,800 in a lump sum, in 60 days, from a budget that was generating nothing resembling a surplus. You went to all 5 stores. You extended all 5 loans. You opened a 6th loan at a new place, an online lender this time, faster, more convenient. The fees slightly higher, the process frictionless in a way that made the decision feel smaller than it was. You found an apartment. You moved. The 6th loan had cost you $180 in fees and added $300 to your outstanding principal. The back pain got worse in month 20. You went to an urgent care clinic, the cheapest option you could find, and they gave you a diagnosis, a prescription you couldn't fully afford, and a referral to a specialist you couldn't afford at all. You filled half the prescription. The pain became manageable in a way that was different from better. You were late on a loan payment for the first time in month 22. Not by much, 3 days, but the late fee added $30 and triggered a clause you had read and not retained, and the lender added a penalty that reset part of the fee structure. You called to explain. The person on the phone was not unkind. They were also not moved. The system had rules, and the rules didn't contain exceptions for back pain in 60-hour weeks, and a body that was beginning to stop cooperating. The diner closed in month 23, not because business was bad, because the owner retired and his children didn't want the business. You were given 2 weeks' notice and a final check. You had 3 days between jobs before you found something else. A fast food counter, lower hourly rate, less tips. 3 days without full income and a budget calibrated to 0 margin. The loans felt the gap immediately. 2 rollovers became unmanageable in the same 2-week window. You called your mother, who still had nothing. You called your sister, who still had less. You called a nonprofit credit counseling service that a woman at church had mentioned, and a counselor named Dennis spent 45 minutes on the phone with you, reviewing your situation, and explained, gently and thoroughly, that you were in a debt trap a specific, documented financial mechanism in which the fee structure of payday loans makes repayment of principal mathematically improbable, without a lump sum that most payday borrowers cannot generate, and that you had several options, none of them quick and none of them without cost. The options were: continue as you were until something structural broke, attempt a debt management plan that would require you to close all 6 accounts and make consolidated monthly payments over 18 to 24 months, or file for bankruptcy. Dennis did not recommend any of these options over the others. He described each one accurately. He gave you his number for follow-up questions. You thanked him and hung up and sat at your kitchen table with the handwritten calendar on the refrigerator in front of you and did nothing for a while. In month 26, something structural broke. The fast food job reduced your hours in a slow period, from 32 hours to 18, and the hotel cut weekend shifts because occupancy was down. Your income for that 2-week period was $420. Your loan fees due were $315. Your rent was due in 5 days. There was no arrangement that closed the gap. You let 2 loans default. Default meant collection calls, which meant the phone that your employers called you on ringing at hours that made it hard to sleep, which made the 60-hour weeks harder, which made the back pain worse, which made everything slower and more difficult and more expensive in the way that poverty is always more expensive than the alternative. The lender sent the defaulted accounts to collection agencies. Not the collectors from the other story, but the same machine, the same calls, the same techniques applied to a different person on the same economic floor. You file for bankruptcy in month 29. Chapter 7. It cost $338 in filing fees, which you borrowed. Not from a payday lender, by then you knew better, but from a co-worker who understood. A legal aid organization helped you with the paperwork. The process took 4 months. At the end of it, 6 payday loan debts totaling approximately $1,600 in outstanding principal were discharged. You had paid, over 29 months, approximately $4,200 in fees on that $1,600 in principal. You had paid more than 2.5 times what you borrowed, and you still owed it until a federal court said you didn't. The numbers: the original repair, $340. The amount borrowed across all loans at various points, approximately $2,200 in total principal. The total fees paid, approximately $4,200. The total cost of a $340 car repair, routed through a payday loan system over 29 months. $4,540, a bankruptcy filing, a credit score that would take 7 years to recover, and 29 months of a specific kind of stress, the stress of a person managing a financial system that was designed to be unmanageable, applied to a body and a life that were already running at capacity. The industry collected $2.4 billion in fees from Americans in a single year. The average payday borrower takes out 8 to 9 loans per year. 80% of loans are rolled over within 14 days. The stores are concentrated in low-income neighborhoods, in states with weak consumer protection laws, near military bases, near the people who have the fewest alternatives and the least margin for the fees that the system generates. The yellow and orange sign says cash today. What it means is, we will lend you money you need now in exchange for money you will not have later, on a schedule calibrated precisely to the gap between what you earn and what you need, and we will do this repeatedly until something breaks. You have a car. It runs. The belt was replaced in February 2014 for $340, which ultimately cost $4,540 and 29 months of your life. The car runs fine. You drive it to work every morning. You have never been back to a payday loan store. You have a savings account now. $400 in it, built over 18 months, $20 at a time. It took a bankruptcy in 3 years and a credit counselor named Dennis to build what your grandmother would call a rainy day fund, which is what the yellow and orange store was selling you a broken version of at 391% annual interest on Airline Highway in Baton Rouge, Louisiana. The belt cost $340.